Bitcoin just absorbed billions in institutional capital, yet retail ownership is near multi-year lows. This raises a serious question. If Bitcoin was created for individuals, why does a growing percentage of the supply now sit on corporate balance sheets and inside ETFs? Welcome to Mr. DJ Finance. Today, we're analyzing if Wall Street is taking over Bitcoin. Since the launch of spot Bitcoin ETFs, institutional inflows have crossed tens of billions. BlackRock's IBIT alone accumulated over 300,000 BTC in months. Combined with other issuers, ETFs now control a huge chunk of the liquid supply. On-chain data shows large entities are accumulating, while smaller wallets, typical of retail investors, have been selling into the rallies. But here is where it gets critical. Bitcoin's fixed supply means that when long-term buyers move coins into cold custody, those coins become effectively illiquid. This reduces available market supply, which historically amplifies price movements. Michael Saylor's MicroStrategy is the prime example, holding over 190,000 BTC. His approach is not trading, it's treasury conversion, viewing Bitcoin as a superior store of value to cash. This strategy permanently reduces the circulating supply. And this is the part most people are missing. Institutional ownership does not equal network control. Bitcoin's consensus rules are enforced by miners and nodes, not by coin holders. Owning a lot of Bitcoin doesn't let you change the protocol. However, large holders can influence market liquidity and derivatives. It's a financial layer influence, not a protocol takeover. But this convenience comes with trade-offs. Spot ETFs introduce custody risk with regulated third parties, a layer that doesn't exist in self-custody, and there's leverage risk. Institutions use derivatives and collateral, which can introduce systemic risk during deleveraging events, importing traditional financial dangers into the crypto ecosystem. There's also a credible argument that institutional dominance increases correlation between Bitcoin and traditional assets. We've already seen Bitcoin trade in line with the Nasdaq. If it just becomes another macro risk proxy, that challenges its narrative as uncorrelated digital gold. So where does this leave retail investors? The game is changing. It may be less about chasing momentum and more about understanding custody, time horizon, and the evolving market structure. So here's the question. Does institutional adoption validate Bitcoin as a global store of value, or does it pull it closer to the financial system it was designed to escape? Let me know your view in the comments. Stay sharp, and I'll see you in the next one.